Hey, Barbara.
How's it going?
Pretty good. Thanks for joining us. I was just going to go ahead and get started. I'm just going over the HRA benefits with Rita. And then David's just going to be available for any questions regarding, um, tax questions or anything like that. Of course, David is not a tax consultant, but he understands the law. So if there's any questions regarding that, he can make himself available for any questions you might have, Rita, concerning some of the tax ramifications. And then, of course, Barbara, you will make yourself available for any questions concerning like just rounding out the benefit package for the HRA. So on that note, I'm going to go ahead and get started. Rita, as I mentioned before, I'm going to go ahead and do a share screen. So I got the recording going right now, so it should capture everything. Go ahead and. So let me know if you're able to see my screen.
I am.
Okay. All right, so if you could see my screen, this kind of gives you a little bit of a brief overview about the HRA. We're primarily looking at something which is called a QSC HRA. It's a qualified small employer health reimbursement arrangement. And as I mentioned before, it carries some tax advantages, but more important than anything else is that it allows you to be able to do employer contributions, a tax-free employer contribution, to be able to reimburse for premiums that may be spent for your employees. So what that means is that you don't have to have, go ahead.
Oh, should I ask questions throughout, or
Yeah,
you want to wait till the end?
If you want to jump in, yeah, if you want to jump in with any questions, feel free to do so.
Okay, so right away I have a question. You said that HRA allows employers to make contributions, toward employees' medical premiums. Now, HSA, on the other hand, is also an employer contribution, as I understand it.
Correct.
But it's different than HRA, right?
That's correct. I'm going to explain the difference between the two.
Okay, got it.
Yeah, the HRA is a reimbursement. Again, it has tax advantages just like it does with an HSA. But the way that an HRA is structured, it's a little different than an HSA. They are compatible where you can be able to combine an HRA and an HSA together, and then you can be able to really increase your what they call the triple tax advantage. I'll get into that a little bit. But the way the HRA is designed is that the funds stay in-house for the employer until the claims come through for reimbursement. So, and because it's tied to payroll, that's where the tax breaks comes in for the participants. And also there's some tax advantages for the employer as well. But what this here is, it just kind of explains a little bit about the small business relief. There's a safe harbor now for small businesses concerning, as you know, as well as I do, that rates are increasing around group benefits. And the pandemic is just not the only thing that factors in with rates going up. And so a lot of companies are looking for alternatives. Well, this is a more cost-effective alternative to go with. And one of the reasons being is that you can be able to do something which is called a defined contribution. Now, years ago, it's just like, companies used to do defined benefits. They had these pension plans. And so they got too expensive and they were just pricing themselves out. And so the markets changed. They did a paradigm shift. They went from defined benefit to defined contribution. And that's what we're seeing in the health insurance industry now, is companies are beginning to move from, doing traditional group plans to where they're moving to now these defined contributions, which is an HRA. And how that works is just basically when you set up the plan documents for an HRA, it's very simple to do. it's just a set of documents that says that you will be doing reimbursements for qualified medical expenses. When they send in their claims for reimbursement, it just get reimbursed back to the employee on their payroll. But
Now, when you
go ahead.
say when they send in their claims for reimbursement, what
Mhm.
about the premium? Every month, they have to pay the premium,
Correct.
which is to me different than a claim reimbursement.
Well, exactly. When they're submitting a claim for reimbursement for their premiums or any medical expense, there's a process
Oh,
in which they do that. It's very simple, because I know that was one of the questions that you had about the administration,
yeah.
which I will show you how we actually do the process, how to set it up, um, what the cost is for your plan documents. It's nominal compared to what you're paying for your group rates. So let me just run it right down for you. Okay.
Sure.
All right. So if Sentinel Restoration want to decide to go this direction, I will send you a link. I'm going to explain it a little bit more in detail, but you just basically fill out your information. This is an order form. It's a one-time cost of like $199. This is basically your plan documents to set it up. But this also, once you get this set up, you have something where you can be able to manage your accounts. And let me just show you what that looks like over here on this side of the house. You will see where you have on my site, you have HRA employee login. So all of your employees will basically have their own accounts. So you guys decide for how much you want to be able to expense for your contributions per month. And I'm going to show
Is
you
there
how
a limit?
no, there's no limit as to how much you want to. So that's what I was getting at. So like if Jeff or Lance, they're higher income earners in the company, they want to be able to, well, they can offset their entire cost. So they can be able to take the deduction and also the tax advantages through the company by doing their reimbursement for their premiums. So like say if it's $800 a month, they can offset the entire cost with their premium or with their premium contribution. So they can actually designate it by classifications, which we'll get into that in just a sec. So you can look at different classes of employee classifications to be able to set your contribution limits, okay? But each one of
Okay.
them will have their own account. And we manage all of this for you guys on the back end too, but you have an admin portal. So if you wanted to log in and manage and look at, you can be able to do that too. So you'll have an admin panel. But all of this here allows them to be able to submit their claims reimbursement. They log in. We create an existing account for them or create an account for them. They can be able to log in and then they can be able to submit their claims. And we can look at the claims when they've been reimbursed. If it's still pending, typically it takes about anywhere from 48 hours to 72 hours to be able to do a claims reimbursement. And
And again, just to clarify, when you use the term claims reimbursement, that also means a premium reimbursement.
exactly, because it covers for quite a few different medical expenses. So if there's dental or vision, chiropractic services, there are a number, office visits, there are a number of qualified medical expenses that qualify for reimbursement, including premiums. So what's
right.
nice is that you can actually toggle where it can be an automated pay. So if we know, for instance, that every month we're going to reimburse for our premiums, they can set it up where it can automatically, do the claims reimbursement for them for the premiums. Or whatever reoccurring expense that they, medical expense that they may have, they can set that up on an auto bill. And it'll automatically do it for them every month. So this is another option that we can set up that would just simplify the process.
All
Okay.
right.
Another nice thing, besides having a group plan, is that there's no renewals every year. So you don't have to go through, the plan administration of doing enrollments for all of the employees. Another nice thing about this is that You're not responsible for the healthcare spend of your employees. So if someone have a high claims thresholds for medical expenses in the group, the rates go up every year. Well, that's not the case, because I know you had questions about, well, what happens if you're on the individual, then are they getting rate increases? Well, the laws are a little bit different on the individual side of the house concerning rate increases. They can't have more than the 3%. It's what they call a COLA, cost of living allowance. So it can't increase more than 3%. On the individual side, that's not the case on the group side of the house. You can get double-digit increases just depending on what your claims threshold. So there's sky is the limit on group. They can go as high as they want to as far as rating up and putting loads and things like that to be able to offset their risk at the carrier.
Okay.
So you don't have that on the individual side of the house. All right, so let me show you now. You might be questioning, okay, well, what would this look like on the individual side? Like, what are some of the the plan options? And so I'm going to go through that really quick. Now, did you have any questions on the HRA in itself, how it's structured or how it's designed, the admin or anything like that, before I move into this next part?
Well, not yet.
Okay, good. All right, let me. Okay, Rita, you can see my screen, right?
Yep.
Okay. And so, because we're working on individual plans, I'm going to use my zip code, 601. And what's neat about this is, because we are a web broker for healthcare.gov, this is our platform that we utilize for healthcare.gov. And it's very simple. Employees don't have to plug in all of their personal data or anything. We can actually look at their information on the fly to see what they qualify as far as taxes go. So let's just say that I was a employee in your company and I make $30,000 a year. What I'm going to try to do is qualify for a tax credit. Now, what happened just recently, I don't know if you paid attention or not, but laws are constantly changing around all these benefits. It's kind of a fluid environment. And one of the things that Biden administration has done is they've enacted something which is called an American Rescue Plan. And what it did is it increased it. It's part of an extension of the tax relief bill that's been added. So what it does is it gives people more money. So I'm going to show you that here in just a little bit. It's more of a contribution than what people can get inside of an employer contribution. It's much more. And so depending on what they make. So we're going to look at that. And this is why I'm saying you can bring costs down for employees now by migrating out to these individual plans and still provide an employer contribution through an HRA. And so using my information as an illustration here, I'm just going to pull up and see what I would qualify for a tax credit. Say if I'm making $30,000 a year. It's going to ask me a set of other questions. I'm just going to skip right through that, but you see that I qualify for 663 at that amount. What that means is you'll see where it says that I qualify for plans as low as $0 per month. So what it's going to do is it's going to apply the 663 to my premium every month. And these is all the big name carriers that from Priority, from Health Alliance Partners, from Blue Cross Blue Shield, the HMO side of the House of Blue Care Network. I mean, all of them are in there, which I will show you. But this is what employees can achieve, if you decide to move out this direction. Now, again, it's based on incomes. But what this new bill did is it raised the bar so that people qualify for more tax credits now. And so like right now, when you're doing a group plan, you're on the hook for all the costs. The employees are and the employer, and that's it. you don't get any help. But if you're doing it this way, you qualify for government help now. And so it can bring the cost down for the employees. You're providing a little bit of a contribution. You're picking it up. So between the employer and what you can be able to get on healthcare.gov, it rounds out your benefit portfolio in a way that brings down your costs, and you can expand your benefit package.
Okay.
Okay.
Now, do you happen to know where the cutoff is in terms of, you know, salary and the amount of subsidy that the government provides?
Well, it depends. Let's just say, for instance, I'm going to go back and I'm going to modify this, and I'm going to show you how this works. It depends on the number of people you have in your household.
Yeah, okay.
It depends on what you make for that total household. So let's just say that if I have a wife and 2 children, there's 4 of us in our household. Okay. Now what that does is that if I try and at 30,000 is my total household income, that's going to put me into Medicaid. That'll be in the state program.
Okay.
Okay. But now let's just say I make $60,000 between my wife and myself. Okay. Then that's going to change. No, they're all applying for coverage. Okay. And so let's try that again. So you see what happens now?
Yep.
You know, so even in that case, I went up to 60,000. It qualifies me for $590 for now. Again, that doesn't go that far for a family of 4. But let's take a look. Now it's going to tell me here, I still qualify for 0 per month. You see that?
Yep.
For a family of 4. So let's take a look and see what these plans are going to look like. So I put my wife on, I put my kids. And so you can see that the income level, the more children that you have and the more individuals you have in that household, you know, the higher your income can go up. So you can go up to 100,000 and still qualify for some tax credit. Might be $200, 150, it'd be something though. But you can go all the
Okay.
way up to 100,000 and still qualify for something.
All
You
right.
know,
And if you don't qualify for anything,
that's when the HSA contribution will kick in. So
yeah,
like if
okay.
you don't make anything or you can't qualify for anything, like the higher income earners, they're well above $100,000 and plus, then, you know, they're already paying for that right now. The
Right.
difference is in taxes is that on your group plan that you have, you know, Section 125, it carries, you know, pre-tax benefits. Well, you're going to get that. You're going to get the same thing on the HRA side of the house. So you're just going to be able to offset your costs by reimbursing your premiums through the business, through your HRA. So it's the same, you're just doing it a little different, same concept though.
All right.
All right, but here's where it works well for the employees is because what companies found out during the pandemic, you know, there was a lot of layoffs and furloughs. And so employees were losing their benefits, their health insurance coverage, you know, during a pandemic. And so we were saying that it makes sense to have the individual plans because there's no break in coverage when there's a break in employment. And so by doing that, you can not only provide them a more customized benefit solution, but they can also qualify for tax credits. So even if you know, they lose their job and you can offer them COBRA, a lot of times they can't afford it because they're on the hook for the entire cost of that group premium. While they're in term to try to find another job, they just can't afford it. But if they're getting a subsidy, typically they can handle that subsidy or that premium payment if they're getting the subsidy while they're in term between getting. So sometimes we're saying the individual plans could make more sense. It could be a more financially suitable benefit option for employees. All right, so what we're going to do is take the $590 now and we'll apply that to a premium, to a plan. So You know, if I'm a young guy and I'm not really interested in paying a lot of money, you can see that the high deductible health plans, they come in at zero premium amount.
So
know.
how does that translate to the employer? So if we have an employee that selects that plan, that's not costing the business anything. I mean, I'm guessing that, I mean, the business doesn't have to pay the premium. However, the business is going to have to pay that deductible, which is $7,000 a year.
Well, yeah, here's where here's where the HRA comes into play. The employer role in all of this is in the contribution. You set up an allowance and you guys designate, and I can help you through this process as to what you feel is fair and equitable across the board for an employer contribution to your employees. That money, it accumulates every month. And you can make it roll over every year, like a HSA. So those dollars can accumulate and they can roll from year to year. What happens is when those dollars accrue, they can apply them to anything. So let's just say that they're not paying a premium, but they have money that is calculating and accumulating for them through their HRA. And they can go in and they can look, like the account that I had showed you, they can look and see that the numbers, they could see how much money is accruing for them every month. And so let's just say that they needed to make a purchase or they needed to expense for medical reasons. They can use those dollars in their HRA to satisfy their deductible, to pay for other medical expenses, which, by the way, will count towards their deductible. So they utilize those dollars in their HRA for any and everything, whether it might be for, like, you know, glasses, vision, dental, chiropractic services, and a number of things that they could utilize those dollars for. So this is another thing that I'm getting at. So if you qualify for zero deductible, or, you know, they qualify for zero premium every month, they can still utilize their HRA dollars to satisfy their deductible and other medical expenses. You can't do that right now with the group plan that you have. That's an option that don't exist in the group, in that traditional group environment, that you could be able to do on this side. That's what I was mentioning before, is that we have the ability to control costs and be able to build out your benefit portfolio more so than we can in a traditional group. Like when the rates are going up for group, all I can do is just start diminishing your plan designs. I can raise your deductibles. I could increase your out-of-pocket maximums. I can be able to, you know, your costs will go up on your office visits and your copays, and I'm diminishing your plans to try to offset cost increases that are coming. That's all I can do. But on this side of the house, there are a lot more things that we can be able to do to control costs and make your benefit plans more robust. Okay.
Okay.
So that's basically it. Now, one of the things that I wanted to be able to mention to you, and why I have Barbara on this call as well, is because, you know, when you start making the leap from the group to looking at individual plans, you're going to find that on the individual markets or exchanges, a lot of these plans are high deductible. Let me show you something. When you start getting into the lower deductible plans, you know, your costs start going up considerably.
Sure.
So let me jump to some of the lower. Okay. So you see that 2,500?
Yep.
You know, that's actually a standard deductible on these exchanges. They can run from like 2,500 up to 8,000, you know, more for your deductible. That's a lot of money that people are on the hook for to satisfy that deductible before their benefits will kick in. So a lot of times, yeah, you can be able to have, you can couple an HSA as well. So let's just say that, you know, the individual is opting to go with a high deductible. You know, the company, you guys can set up an HSA, a company HSA, to be able to offset some of those out-of-pocket expenses. And you can do an employer contribution to the HSA as well. So now that you're bringing your costs down, you're getting help from the subsidy and what have you for the employees. And you're controlling your costs because you're providing a fixed budget for your contribution every month. Now you might be able to put money aside for an HSA, which is like another kind of retirement plan because it's tax-free. And a lot of times I like to think that, you know, the HSA can be more superior than a 401k in some cases, because that 401k up into a certain age, you can't take any money, you can't withdraw from it without invoking a penalty. That's not the case with an HSA.
Right.
An HSA, you can pull money out for qualified medical expenses. In most cases, tax-free.
Yep. Okay. Question.
Sure.
So the purpose of contribute for the employer to contribute to both the HRA and HSA is that it increases the amount of money that you can contribute. Otherwise, I mean, maybe to rephrase the question, why would a company want to do both an HRA and an HSA? Why not just put all of the contribution into the HRA?
Okay, that's a very good question, Rhea. And let me explain why. Some companies decide to do both. The HRA basically is money that is reserved on the employer side of the house. Employees cannot contribute to an HRA. They can't put funds towards their HRA. Contribution dollars are set by the employer and they're managed really inside of the employer account. That's where you have software to actually manage all of that for you. The HSA is different. The HSA, the employees actually own the dollars in that account. So when you're putting money over there, it's money that goes with them when if there's a break in employment, they still have those dollars. So let's just say that the employer is doing a contribution on the HRA, and they also want to be able to do a contribution to the HSA. It don't have to be a lot. You set your budgets on that side of the house as well. But what that does is it also gives them money to be able to utilize if they want to be able to build for retirement. So because there are a lot of tax advantages around the HSA. And so you can grow money tax-free inside of that vehicle. So some of your employees may opt to say, you know what, I don't want to touch any of that in there. I'm going to treat it like it's an investment like anything else. I just want to have money grow on that tax-free. They can roll that money from year to year and they can be able to, roll it over at 59 and a half years old to some other, but they could use that as a retirement strategy. So like you don't have to have 401ks or anything like that set up for a small group. If you're utilizing HSAs, it's another retirement vehicle that you could utilize to grow money tax-free. So that's the big difference between what an HSA can do and with the HRA. And sometimes companies, when we can bring their costs down with the subsidy involved, they choose to be able to do both. They find that they have enough money in the budgets to be able to do both because it brings your costs down significantly when you go this direction, as opposed to trying. What happens is when you're doing group, all of the money is just getting absorbed in the group. So you don't have room to do anything else. But what happens is when you start migrating out to an HRA, you find that you have money to do other things. You can round out your benefit portfolio in a way that you can't do with a group plan. So
Okay.
does that kind of answer your question?
Yeah. Now I do have it like a tax question. So, right now with the group health plan, that is an allowable deduction for the business. So of course, every year we deduct the amount of money that we pay for our group health
plan, correct.
Premium. So, which is nice. But what I think I hear you saying is that we would still have a deduction because of any of the money that we're contributing toward the HRA, that's an expense that the company's paying. So we'd get that deduction. And I
Correct.
think I've heard you say before that there are some additional tax advantages for the business.
There is.
Is that correct?
That is
Okay.
correct.
And
On the
should I hold off to get that answered until the accountant talks?
Well, yeah, what I'm gonna, yeah, and also what I'm gonna do is I'm gonna send you some information on the tax advantages of an HRA. There's an IRS publication. I want to send it to you directly from the irs.gov. And there's a literature that talks about the tax advantages of an HRA. So I want you to be able to take it to the bank that, just not a couple of, you know, uh, industry experts, benefit experts are telling you about this stuff. I'm going to send it right from the source. And then also, I have David, which you
Okay.
can consult with as well, But I
Okay.
would be happy to send you the information on the HRA. And the other part, what I'm getting at is for the employees, is that, the triple tax advantages with the HSA. It's a pre-tax benefit with the HRA because it's tied to payroll. You lower your FICA and SUTA by $125 per participant. You'll see that in the IRS tax code when I send that over to you. But those are tax advantages now that you can leverage. You guys are taking advantage of some of them inside of the group. You're going to have more of those tax advantages inside of an HRA, just because there's more plan design and more flexibility that we can do around it. That's all.
All right.
That's it.
Okay, and then while we're still talking about what the employee has to do, so basically the employee is going to look through, well, in this scenario, there's 30 plans for that employee to look at and decide which plan, is most suitable for them.
Correct.
So there's some upfront work that the employee, is going to have to do.
Well, actually I have your employee demographics. I have their personal information and data.
Yeah.
Rita, all I would need to know is like with their household income and things like that. I can run the numbers. We can do that over here on our end. I can vet all of that for you. And then I can,
Okay.
I can have a pretty good idea what it will look like for your group. And what the individual side of the house will look like, who's going to qualify for what tax credit, what plan options would make the most sense. We all have our recommendation on, how we
Okay.
want to
All
move
right.
forward with them,
Okay, because that was one of Jeff's concerns, is that, kind of putting the onus on the employee and the amount of time that they're going to have to spend, going through this process that you're showing me. So it would be really helpful, like you said, to take you up on your offer to help vet some of this.
Yeah, remember that's what I was saying, is that we would be more involved with your employees, and it would be a change in culture because, employees, when you have a group plan, they just sign up and, they don't really think about it until they need to go to activate their benefits. On this side of the house, it requires us to do a little education, but we do all the legwork on the back end. That's what a benefits agency do. And so, the onus is on us to be able to, do all of the fundamental legwork and, the back end support. We do that for you. But when it comes to understanding how this stuff works and things like that, that's up to the individual to take the time to understand that process of it. We can't force feed these things into individuals that don't have a need to want to know. We have to try to teach people that want to have an understanding. So when things are doing, that occur, they're not reactive, they're proactive. They kind of understand how the benefits work.
Yeah.
And so, that's the really big transition that we have to make, going from traditional group to this type of benefit platform. It's a little bit more hands-on.
I mean, I'm all for it. I don't have any reservations about it. Quite honestly, it's, each individual, each employee has to go through this process in the context of, auto insurance, homeowners insurance. So really, why should medical insurance be any different?
Exactly. So you're getting it now, because our industry is moving away from group. Group is a dying model. I'm telling you, in another 15, 20 years from now, we believe it's going to all be individual plans, and that, because most people don't keep the same job until age 65. We know this to be a truth. And so what happens is that we got windows to when people can actually get insured. And so if they're leaving the job and open enrollment on the exchanges are not available, people have to go and get short-term plans and things like that in order to carry them over to open enrollment. Well, if you just have your individual plan throughout the year, you don't have to worry about, losing your insurance, or, you take it with you. It's portable. So you don't even have to worry about COBRA or, HIPAA compliances or anything like that, because you own your own individual plan. And we know our market is going in this direction. It's just that we know that a lot of employers are just slow to adopt these new concepts that are here now,
Yeah.
So
Yeah.
what I'm going to do is I'm going to turn it over to Barbara. She's going to talk to you a little bit about rounding out the benefit package, so that the higher deductibles that we're looking at right now might not be as a financial burden for your employees. So on that note, Barbara, you can go ahead and explain what you do in our world, and how we can be able to help round out the benefit for if they decide to go this direction.
Perfect. Thanks, Eric. Hi, Rita.
Hello.
I've been working with Eric for a while now in terms of helping people actually customize their plans according to their own needs and their risks. And that's where Aflac comes in. You probably have seen a lot of the commercials with the duck, right?
Yes.
Okay. Aflac exists because people have in just about every situation, there is some deductible, there are co-pays, things like that. And we know that when something big happens, Eric, mentioned that people don't have the bank accounts to be able to handle some of these deductions. And that's with the big event, that's where it hits. We know that 87% of the bankruptcies that occur are because of medical events, and most of these people had major medical. So there's a disconnect in terms of